And we're getting pretty close to the hour, but you know what? I'm going to go over the hour, I think, a little bit, because this next story is just worth it. I mean, if this was a movie, I think people would accuse the movie makers of simply being unrealistic, because there's fraud, and then there's what this next story describes, which is completely, it's a new level. It's a new level, and on one side, investors, you know, I usually say, you know, listen, investors should have known something was up. They should have looked at the filings. They should have been more aware. But in this case, it's just a fact that investors had no idea, because this company that I'm about to talk about, they defrauded everybody. They went to so much trouble to execute this fraud that had they put that effort into running a legitimate company, they would have been highly successful. Okay? So this is a story in Bloomberg Business Week. It says, ex-NFL star Willie Gault sued by SEC in stock pumping fund. Now, I don't know about anything about sports. I don't know anything about the NFL. But if this guy, Willie Gault, throws a football half as well as he does fraud, I'm impressed. All-around Renaissance man. It says, Willie Gault, the former NFL wide receiver and Olympic sprinter, was accused by U.S. regulators of taking part in a scheme to artificially inflate the stock of a medical device company that he helped manage. Okay. It says Gault, 51, was installed as Heart Tronics president and co-CEO in October 2008 to generate publicity for the company and foster investor confidence, the SEC said. Stein, who controlled most of the company's business activities, hired promoters to tout Heart Tronics stock on the internet. The defendants reaped nearly $8 million by trading the stock, according to the complaint. It says Stein, who was one of the people involved, Stein took advantage of Gault's celebrity to further prop up the image of Heart Tronics as a successful enterprise. And here's where you get a glimpse into the extent to which these people went to execute this fraud, which is it's quite astonishing. It says Stein and Carter, another one of these people involved in the fraud, fabricated several documents to support false disclosures to the public, the SEC said. In one instance, Carter made a one-day round-trip journey to Japan at Stein's direction to mail back a letter from a fictitious customer in order to deceive management, disclosure counsel, and auditors, according to the SEC. Wow. Just wow. To go to Japan, to mail something, to make it look like it came from Japan, I haven't heard that before. I'm kind of, I don't know if I'm angry or impressed. It's quite unbelievable. That's certainly a new level. It says they also arranged to ship products to one of Carter's friends to create the illusion that the company was delivering a heart monitoring device to an actual customer. Now, this is the extent to which Bloomberg Business Week covers this story, which is okay, but the problem with all of these stories is they never get into the nitty-gritty details. So I went ahead and obtained the complaint. It says between December 2005 and December 2008, defendant Mitchell Stein, the purported outside counsel of Heart Tronics, and husband of its majority shareholder, orchestrated a brazen series of frauds designed to inflate the price of Heart Tronics stock so that he profit from selling the security to investors. Which is, the word brazen, I think I agree with. I think it describes this fraud pretty well. It goes on to say, Stein held himself out as the Heart Tronics outside counsel and claimed not to be the company's officer or director. However, in practice, Stein was a de facto officer who controlled many of Heart Tronics' business decisions and public disclosures. It says in that capacity, Stein orchestrated the repeated announcement of fictitious sales orders for Heart Tronics products in public filings with the Commission, which is the SEC, in press releases and other public broadcasts, all designed to make it appear that Heart Tronics was more successful than it actually was. And Stein is the one who put the football player as a figurehead and co-CEO to help promote the stock. Goes on to say, they directed the sale of more than $5.8 million worth of the stock without disclosing it to the public as required by law. And the Steins used the proceeds of the sales to fund their lavish lifestyle, which included multiple homes, exotic cars, and private jets. One of the things they did, these people were clever. I'll give it to them. They created blind trusts They used it to create the facade that Stein's Heart Tronics stock was held by separate legal entities under the control of an independent trustee, when in fact the trusts were blind in name only. It says the Steins made regular demands for cash by continually selling Heart Tronics stock through the trusts, and these blind trusts were used as part of the scheme. So they were pretty advanced in executing this fraud. You got to give them that. So that's a little bit of background. But when you get down into the details, that's when it gets hilarious. I mean, I can't think of what these guys didn't do. Let's take a look. On approximately September 14, 2007, Heart Tronics contracted to sell at least $2 million worth of its Fidelity 100 product, which is one of its widgets that it was selling, to an individual located in Portland, Oregon, who had a prior relationship with the CEO of Heart Tronics. More specifically, the customer signed an order to purchase 180 units of this Fidelity 100 machine for $1.9 million. Stein negotiated and drafted the purchase order with the customer, and it was signed on behalf of Heart Tronics. It says this letter was one of the many bogus documents created by Stein to create the illusion that Heart Tronics had a viable sales order. Stein provided the fraudulent letter to Heart Tronics officers, and the false document was retained in the company's books and records as support for the continued disclosure of the pending sale. Now, this was material, which means that this $1.98 million was definitely would have an impact on the financial statements that would affect investors and would affect their decision making. And the question is, why didn't the auditors find out about this? Where were the auditors during this whole thing? And that's a question that still boggles my mind to this day. This was a company that traded publicly on the American Stock Exchange. Why was none of this found out earlier is my question, you know, and that's another issue that I want to get to. This story really raises a few important questions that have yet to be answered. Now, they not only fake their transactions, they also fake the confirmation. When auditors conduct an audit, they rely on confirmations, which is an affirmation by a third party, which says, we have done the transaction with your client, or we have these pending transactions with your client, or this client has this many deposits with us at the bank, so on and so forth. It says, for this $1.98 million sale, the Heart Tronics CFO and disclosure lawyer sought to obtain confirmation from the counterparty for its intent to complete the purchase. Stein provided them with a toll-free fax number, purportedly for CHM, which is this other party, to which they could send a request for confirmation. On March 21st, 2008, the disclosure lawyer and CFO faxed the confirmation letter to CHM at the number that had been provided by Stein. Unbeknownst to the disclosure lawyer or CFO, the toll-free number had in fact been registered by Carter at Stein's request as part of the scheme to continue the facade that there was a legitimate purchaser on the other end of the CHM sales order. Now, on March 25th, 2008, a confirmation letter purportedly signed by CHM's, quote, Tony Noni, which was a different spelling of the name that was used before, so they couldn't even get the spelling right. It was returned to the disclosure lawyer and CFO by fax. In fact, it was Carter who was pretending to be Tony Nomi, and Carter is one of these guys who work for the company. So that was just one of the things. So they faked confirmation, they faked sales orders. It's quite unbelievable. It says in September 24, 2007, Heart Tronics purportedly entered into an order to sell 300 units of the Fidelity 100 to an Israeli entity called IT Healthcare for $3.3 million. Okay, so they're making a sale, IT Healthcare, $3.3 million. On October 4th, 2007, the company purportedly entered into a follow-up sales order with IT for an additional 47 units for about $500,000. All right, so they're finally making some sales. Sounds great. However, it turns out IT Healthcare was a fictional company and not a bona fide purchaser of Heart Tronics products. So they made up companies. They made up confirmations. They take day trips to Japan to deliver confirmations. It's really amazing. The story goes on and on. This is about 57 pages. I'm not going to go through the whole thing. But anything that anybody can think of, these people did. And it's a new level. I wish the news outlets covered this more, because it would make for great news, if not a great movie, wouldn't it? So the questions that this raises really quickly are, where were the auditors? You know, sure, okay, the company faked confirmations, but what about the cash statements? What about the bank accounts? Okay, these auditors should be auditing the cash. And if this company is supposedly making these sales, why was the cash never checked out? Why was it never liquidated through the bank statements? And liquidated means when You look at the bank statements to make sure this company actually received money. You know, and auditors, of course, will tell you they don't look for fraud. Now, if auditors happen to stumble upon fraud, then there are some requirements where they have to make disclosures, but auditors don't look for fraud. Now, the question there is, if auditors aren't looking for it, who is? And that's a question that remains to be answered. So basically, as a company is running like this, with all of this misrepresentation going on, the auditors are kind of looking the other way, possibly because of the conflict of interest. Let's remember who auditors are paid by. They're paid by their client, and they don't want to lose clients. So that touches upon that aspect as well, the whole auditor-client relationship, which I'll definitely talk about more in a future webcast. But I just wanted to show you a quick screenshot here of the Heart Tronics stock, which no longer trades on the American Stock Exchange, but it trades over the counter. And this is just a quick lesson in over-the-counter stocks. We can see that in June, and even as recently as September, the stock was trading at $1. And now, a few months later, it's worthless. Okay? That right there, I think, shows you everything you need to know about over-the-counter, about the risk that's involved. You know, of course, it can go up 50 cents and you make a killing, but it can go down 50 cents and you could be slaughtered. This is an example of stocks that people go into to make a quick buck, but unfortunately it's not always the case, and you may end up with significant losses. So once again, I wanted to thank you for joining me today. If you have any questions, please feel free to reach out and contact me. I wish everybody on the line a great new year, and once again, happy holidays. I hope everybody enjoys the new year with their family and their loved ones. I wish you all the best there. And once again, if you have any questions, feel free to call us at 347-706-1414.